What is happening, everybody? It's your boy, Sean McLaughlin, at Options Sean on the old Twitter X. If you're not following me there, why don't you follow me? I share some good stuff every once in a while. Hey, this is the What Are My Options show. This is a free for all. This is a ask me anything type show where if you have any questions related to options trading or option strategies, best practices, anything like that, feel free to put those questions into the tab, into the chat there in YouTube, and I will do my best to answer them for you. I see a couple questions did come in already, so that's great. Hello, Dan. Hello, SM Traz. Hello, Arminder. Good to see you guys. All right, so before I'll wait for some more questions to come in. I see that some already came in, so that's great. But I want to kick off the show today. Something I wrote about this week. I talked about how one of the interesting things about options that makes them unique compared to, say, futures trading or stock trading is that when you put a trade on, an options trade on, there is an expiration date. Now, there's a variety of different trades you could put on, a variety of different spreads. Sometimes you have different expirations within a spread, like in the case of a calendar spread. But regardless, every option comes with an expiration date. Now, to some people, that can be frustrating. That could be, hey, I'm in this trade and it's working. I'm running out of time. I don't like that. I wish I was in stock and I could hold this thing forever. Well, that's great. Nothing wrong with that. Okay. I want to change your perspective on that a little bit. It's changed my perspective. Something that's dawned on me in recent, say the last year or so, is that I am typically, when I'm trading my best, the types of trades I'm doing are trend following trades. I'm a trend follower at heart. That's where I cut my teeth early on when I started trading. And that's what I do. That's what I do best. But one of the challenges I have, and any trend follower will tell you that they have this too, is the hardest thing we do is sit on our hands when we're holding a large winner, a trade that's going our way. If you want to have really big wins, you need to sit on your hands and sit through some volatility on your way to bigger and higher profits. But at some point, you want to take a profit. Now, the classic way a trend follower will get out of a trade is to have some kind of trailing stop mechanism that gets them out. And everyone has a different rule. Like, if you're maybe you get out at like a 20-day low against your long position, or maybe you get out at a certain volatility retracement, or maybe you get out at a certain chart point level. Either way, you're getting out on the way back down, and giving back open profits feels uncomfortable. And that sucks, right? We all want to get out at the top tick. But if you've been doing this for any length of time, you know that getting out of the top tick is nearly impossible. And when you do it, and if you trade enough, you will get lucky every once in a while and you will get out at the top. And that's exactly what it is. It is luck. All right. But one of the nice things about options is that because of that expiration date, there's kind of a built-in ticking clock to get you out of a winning trade. So if you're in, say, a long call and it's been going your way for who knows long, however, you might have been in this trade for months, but now you're getting into expiration day. Well, one school of thought is, well, I'm in a winning trade and it's going. I could just roll it out to the next month and keep the trade going, right? Yeah, you could do that. But if you do that, then you're still at the risk of, getting caught in a rollover and maybe getting greedy and overstaying your welcome. With an expiration, what I like to do, what I've come around to, kind of the Zen approach that I've come to on this, is that the trade I put on, I picked that expiration cycle for a reason, right? Maybe because when I put the trade on, I thought that this trade needed 3 months to mature, or 6 months, or 1 month, whatever the time frame might be. I picked that expiration series for a reason. It was part of my plan when I got in. And so when that option comes to maturity, it comes to expiration, the Zen approach for me at least is to say, all right, well, it's done what it can do and that's it. I'm out. I have to get out. I'm not going to take assignment of this stock. I don't want to do that. Nothing wrong with that if it's part of your plan, but typically Typically, options traders don't take possession of stock for an in the money option that expires. That's not what you want to do, right? So when it gets to expiration day or it gets close to expiration day, I'm like, all right, enough is enough. This is a big win. We're gonna close it and we're gonna count the gains and we're gonna celebrate the win, and that's it. And here's the thing: if the stock were to then continue going in my direction, instead of being pissed off that I got out of my position, I could then enter a brand new position, a brand new trade in a new expiration month at a new strike and just treat it like any other new trade, right? Just buy the new call or whatever it is that you want to do, size that position as if it's a brand new trade because it is a brand new trade, size it at your risk management level, and then treat it as a brand new trade. And if it continues going higher, great, you're participating. That's awesome. But if it rolls over and sells off, even better, you only lost your minimum risk that you would put on any brand new trade. Instead of, had you rolled your original position forward another month, that in the money call that might be 30, 40 bucks in the money, if you rolled that call just to the next month, the same strike, then you're still holding all that risk. And if there's a big rollover, you're going to get crushed. So use expiration not as it's not a bad thing. It's an opportunity to take profits off the table and start fresh. So that's my little soapbox I wanted to get off my chest. I was talking to somebody. This came up because I was talking to somebody about this over the weekend, and he was or she, excuse me, it was a she. She was saying that she was asking me like, well, I have a winning position. Why would I want to sell it? Shouldn't I roll it over and keep going with it? And my answer was, if that was your plan, sure, but I don't know. You're at some point you want to take a profit, right? And why not just take profit at expiration? That's a really clean way to do it. All right, all right. So let's go. There's a couple questions here. We'll start at the top in no particular order, other than coming starting at the top. SM Traz asked, speaking of delta, how do you decide which delta to use for contracts? Any rule of thumb? Well, of course, it depends on the option strategy you're using, but let's talk about just simple long calls and simple long puts. Okay. Generally speaking, and I don't do this every time, but generally speaking, if I'm buying a long call or a long put and I'm positioning 3 to 6 to 9 months or further out, it's a trade that I want to be in for a while. Generally speaking, I like to buy the 25 delta strike. The reason I like to buy the 25 delta strike is, for me, I feel like that gives me the right mix of affordability, meaning cheap, right? Less cash outlay, which therefore means less capital at risk, and gives me leverage. So if I get the trade right and I get the timing right, then I'll get leveraged gains as the position moves in my favor. So generally speaking, if I'm positioning for 3 to 6 to 9 or longer months out, I'm looking at the 25 delta. Now, if I'm doing something a little bit more shorter term, maybe inside of 2 months, like 1 to 2 months expiration, I might scooch it a little bit towards the at the money call or at the money put. The only reason I do that is because I feel like it gives me the ability to have higher odds of success in a shorter time frame. That's just my gut feeling. I don't have any math or science behind that to back that up. It feels right to me. And look, guys, I've been doing this for 26 years, and you know what? Sometimes I go by feel. I know that could be controversial to some of you who are all about the rules, all about the systems. Hey, that's great. If that works for you, great. But I don't know. I've developed a little bit of a gut feel for things as I've gotten long in my days in this game. But yeah, so for deltas, 25 delta if it's long dated, maybe closer to 50 delta if it's shorter, if it's a shorter term play. Now, of course, if you're doing different strategies require different deltas. If you're like selling naked strangles, for example, where you sell an out of the money call and an out of the money put, I don't know. Generally, I'm looking at like a 15 delta on both the call and the put, something somewhere in that area. All right. If I'm doing a vertical spread, long or short vertical spread, I'll be doing the at the money strike, which is the 50 delta, and then the other leg will be the 25 delta. So, for example, if I'm buying a vertical spread, I'll buy the 50 delta call, sell the 25 delta call against it. Conversely, if I'm selling a call spread, collecting premium, I'll sell the 50 delta call and purchased a 25 delta call against it. Guys, there's no magic in these numbers. Believe me, there's no magic. There's trade-offs for everything in options, which is both frustrating for some and opportunity for others. Depends on your frame of mind. But there's no perfect answer in options. There's a trade-off for everything, right? If you, for example, if you're buying options, if you're buying, if you're debating with yourself whether to buy the 50 delta call or the 25 delta call, well, the pros of buying a 50 delta call is that your break-even level, your break-even price will be lower, meaning you have higher odds of success, right? But you're paying more money for that call, which means if the stock craters, you will lose more money than had you bought the 25 delta call, which would cost less money, but it also has a lower probability of success. But if you get it right, you'll make much greater percentage returns on your money than you would have done had you bought a 50 delta call. Neither answer is wrong. Neither choice is bad. It's just, what do you want? what do you want to weigh in your favor, and what do you care less about? That's really what it comes down to. All right, moving on. Harminder says, loved your note, Shawnee, on forced sell with exit dates, something I completely agree with. Okay, great. You're welcome. So we covered that. Awesome. Traz is asking, Apple, time for leaps? I started buying a few days ago. Well, let's pull up an Apple chart and let's take a look. Pull up my screen here, Gene. I'm looking at the Apple chart. It's been going sideways more or less since, let's call it September. Volatility is at the lower level and coming down. Yeah. If you're bullish on Apple and you want to position for the long term, you want to go further dated, as volatility is coming down, I might wait for it to come down a little bit more just because you'll get better prices, but maybe buying here is not terrible. Let's see. Let's look at what strikes are available in the longer dated options. Boy, we can go far out. We can go 3 years out in Apple. Let's not go crazy. Let's just say we're going about a year out. So next January. Actually, yeah, next January. It's a little less than a year from now. The 25 delta calls for Apple are right about the 340 strike. You could buy them for about $8. So 340 sounds like a far away from here. But what's that? It's about 25% higher, give or take. I'm doing some ballpark math there. About 25% higher from here, but you would have control of the 340 strike from now until January for $8. Now, $8, if Apple completely tanks from here, that's all you're risking is $8, as opposed to buying the stock and you are theoretically at the risk of losing $272 per share. Would you rather risk 272 or 8? Now, look, Apple's not going to go to zero. Highly unlikely, although anything's possible, of course. But the nice thing about buying a leap as opposed to buying the stock is, number one, your risk is defined. I can't lose more than what I paid for this put or for this call. So if I paid $8 for it, that's the most I could lose, no matter what Apple does. Okay, that's advantage number one. Number two is it's a hell of a lot cheaper. Oh, look at that. I got balloons going on my screen. I don't know how that happened. Number two is that it's a heck of a lot more capital efficient to own the leap, the 340 calls that controls 100 shares versus buying 100 shares in the market. 100 shares will tie up a lot more buying power than $800 would for buying the call. So look, I don't hate buying leaps here. Volatility is coming down. I'd like to see it come down a little bit more, perhaps. And, because you're positioning for a year out, you got time. Maybe be patient with that one, but you're on the right track. When volatility is coming down and you got a bullish feeling about a stock that you think will play out over the next year or two, leaps are a great idea. All right. MZ Beto says, hey, Sean, new subscriber here and trying to keep up. I know your initial stop is at 50% below your initial buy-in, but can you describe how you adjust your stop if this trade is going your way? MZ Beto, you are partially right. I don't have an automatic 50% stop on any swing trade that I put on. I assume you're talking about all-star options. I don't have an automatic 50% stop on positions. Sometimes I do that, and sometimes that's a very smart thing to do. But For me, most of my swing trades, they're more chart-based stops. I'm looking at a key level. So for example, since I have Apple up here on my chart, if I were buying Apple here, I would probably use maybe like this 255 level to be my stop. And if I see a violation of that level on the chart, then I'll go in and I'll close my options position. All right. So I don't have a 50% uh, initial stop. Not always. Sometimes I do. But then you go on to ask, how can you describe, or can you describe how you adjust your stop if a trade is going my way? Well, here, let me bring up my other chart platform here. This one is a little cleaner, a little better, and we can talk about actual all-star options positions that we are in. So let's look at what's something we've been in for a while. We've been in this J&J for a while. Okay, so here is a nice, beautiful long trend. This is one of our biggest winners of the year. We're not out of it yet, but still looking pretty good. But I got into this trade back in August. Okay, now I don't remember what my original stop loss level was, but I imagine when I put this trade on, my stop was probably right around 163, 162 in this area here. Okay, as the stock has gone my way, I have raised my stops every so often. Now, the way I do it, it's not math, it's eyeballs. All right. I look at charts and I look at support levels and I raise my stops. So let's zoom in here a little bit. Let's make this a little bit easier. So let's say when we first got in August, when the stock, broke out here and started making some all-time highs, I would probably raise my stop to be right below this recent support level. Okay. So right around 173. All right. Now let's fast forward. If stock goes a little bit higher, let's see when it makes another new high. So, all right, now we're making new highs again. All right. At that point, when we're making new highs, I'm probably raising my stop then up to 185. All right. And then I'll leave that there for a while, let the stock pull back a little bit. And then we broke out again. I'm probably raising my stop up to 200 and on and on. And as you can see right now, this is my actual stop at 220. All right. And 220, I have it there because that was kind of like the upper bound of this little up move. And then it's not rocket science. It's really because when I set this stop on Friday of this past week, 220 corresponded with this rising 50-period moving average, 50-day moving average. And it was, a level that had been previous resistance for a few days at least. So generally speaking, this is not perfect, but if I'm in a trend and I've been in a trend for a long time, like this J&J, I mean, look how beautifully this thing has traded along the 50-day moving average. I definitely don't want to see this stock get below the 50-day moving average. At that point, I think the trend is over, at least on my time frame. And I've got till March, so I got about 6 more weeks for this? No, 4 more weeks for this trade. So definitely don't want to see it get below the 50-period moving average. But MZB's Beto, the way I raise stops is I just eyeball it. When a stock makes new highs in my favor, then I'll raise my stop back below the previous level of support before it broke out. Generally speaking, I try not to be too aggressive on the trailing stops. I try to give these trends room to develop, but caveat alert, these options expire in March. Well, guess what? Today is February 24th. So in a week, it's going to be March. And what I do, my best practice is when I'm in options or when I'm in a trade that I've been in for a while, and then I get into the expiration month, the calendar flips over to the first of the month. At that point, I start getting more aggressive with my trailing stop, because when I'm in expiration month, hey, I don't want to give back all my profits that I've been in. I've been in this trade for 6 months. I don't want to give back all my profits in the last 2 weeks I've been in this trade. That would suck. And this is not the case in this trade because this is so deep in the money. But if you have options that are, relatively close to the money, right? Then at that point, as we're getting close to expiration, the theta decay really kicks up. So whatever premium is in those options is going to more quickly, more rapidly decay as we get closer to expiration. And so I'm going to want to get out on any kind of adverse move against me, because theta decay is my enemy. But these calls in particular are so far in the money. There's no premium left here. These options are trading 1-to-1 with the stock. There's no premium left in these calls, which is fine. That's great. So next week, I will start trailing a stop much more aggressively. Generally speaking, what I do once I'm in expiration month is I'll trail a stop below the 3 to 5 day low. the 3 to 5 day previous, low. So let's say we're there now, right? It's in March and I'm looking at this chart and I'm saying, okay, I'm going to raise my stop. Well, if I look at these candles, I got 1, 2, 3, 4, 5 candles right here. The low is this big red one. That low is about 240. So that would be my stop right now if I had, just a week or two to expiration. That's how I manage my stops getting into expiration. So MZ Beto, I hope that answered your questions. I see some tickers in here. We'll get to those. Let me just scan the rest of the questions here. Um, Venka is asking if a ticker is below the 50-day moving average, but above the price memory low, what's your recommendation? Hold or fold? Well, I mean, I think every stock is a case dependent situation, but generally speaking, if I'm long a stock, I don't want it to be below the 50-day moving average. There's exceptions, of course. Maybe I got into the thing when it was below the 50-day moving average. But if when I got into the trade, it was above the 50-day moving average, I certainly don't want it to be below it after I get in. That would be bad. So that would be a fold for me. Um, so below the 50-day moving average, but above the price memory low. I'm not exactly sure what you mean by price memory low. Um, but look, a good rule of thumb, and I do this more in my short-term options account where I have a lot more trades on, it's a lot more active. Generally speaking, one way I get rid of positions is I do this at the end of the week. I do this on Thursdays and Fridays. I go through all my positions. Well, I don't go through them all. They're just sorted on my screen. I look at all my positions and whatever's losing, I mean, I'll give it a little bit of room. If it's down $50 or something, I will ignore it. But I have a dollar level that I'm looking at. And if it's losing more than that dollar level, I just close it. That's it. I don't argue with it. If I'm losing, I'm losing. Only price pays. That's where our profits come from. It doesn't matter what the chart says. If the position you're in is losing money, well, guess what? Nothing else is going to make it money. So time to get out. So, excuse me. So in my short-term account, I'm very aggressive in getting rid of losers. I don't care what the chart says. Got a little something caught in my throat here. Huh. Okay, I'm just looking through the other questions here before I get into some of those tickers. How do you like to hedge a winning position with an option? All right, so that's from Bill Cyril. Bill Cyril, I hope I'm saying your name right. He wants to know if we'll just keep using this J&J since I got it up on my screen. Let's say you own J&J stock and you've had a wonderful ride like I have, right? But you own common stock. If you own common stock and you're concerned that, maybe there's some headline risk coming, or maybe you just think it's a little overextended, you don't want to sell the stock because A, maybe you don't want to pay the taxes on it, or B, it's a stock you want to hold forever, but you just don't want to sit through any volatility or some severe pullbacks. Well, the simplest way to do that, Bill, is just to buy a put, right? Here's J&J trading at 246. I could draw a line in the sand. I could say, all right, I'm in J&J at right now it's worth 246, but I'd hate to see it get below 230. Let's say 230 is like, okay, I don't want to lose anything beyond 230. Well, you just go into the options market and buy a 230 put. So let's bring up the options chain here on J&J and look at the 230 puts. And of course, you got to select, the timing, like how long you want this protection for. Okay. Let's say you want to be protected through May. For whatever reason, you think that from now until May could be dicey in the market. All right. Well, you open up the Mays, you look at the 220 puts, and there they are. It's going to cost you that's a pretty wide bid-ask spread, but I'll bet you could buy those for $2.50. $2.50 to protect your position. Stock that's worth 246, you could buy a put for 250. That equals 1% of the value of this stock right now. So you're giving up 1% to protect yourself below 220. 220 would be, if you own those 220 puts, you'll always be able to sell your stock at 220. That's what a put allows you to do. Allows you to put the stock to somebody else at the strike price. So if J&J rolls over here, let's bring that chart back up. If J&J rolls over here and trades down to, I don't know, goes back to the 200-day moving average, which is 190, that would suck, but you're protected. You own the 220 puts, and you'll always be able to sell that stock. Not always, but you'll be able to sell that stock at 220 from now until the expiration date, which in this case was May. That's the best way. There are some other ways you could do it. You could do what's called, this is more sophisticated. You could do what's called an options collar, okay, a protective collar, where you could sell an out of the money call to pay for the out of the money put so that the hedge itself doesn't cost you any money, but you do cap your upside. So let's do this. Let's go back to the options. Let's say you want to be protected through May. You could buy those 220 puts, right? But you don't want to pay, you don't want to actually outlay any cash for that. Well, you could go here and sell the May 270 calls. You'll get about 250 for those calls, which you could turn around and pay 250 to buy the puts. Therefore, your cash outlay is nothing, essentially nothing. You got a free hedge, but nothing is free. What you're giving up is upside. If J&J were to rip higher above 270 from now until May, you're on the hook to sell your stock at 270, which, hey, that's a first class problem to have. You're still selling it for higher than it is right now. The stock's at 246. So if you sell at 270, that's another, I don't know, 10% higher. There are worse things that can happen. But those are some ways you could hedge yourself. And look, a collar can be a great trade, right? It's a free hedge down to, in this case, down to 220. You'll give up some profits in the trade now from 246 down to 220, but 220 is your floor. All right. All right. So, Bill, I hope that answered your question. Do, 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 do. Okay. All right. So I think I answered the general or the strategy questions. I have a few tickers people want me to talk about here. So let's go back up. Let's see. Straz was talking about Apple. Oh yeah, we already talked about Apple. Let's see. WT. Let's see what WT's at. This is from Jackson. WT Wisdom Tree. That's a great setup. I like setups like this. Am I in this trade? No, I am not. So look what I'm going to do. I'm going to set an alert for myself. If this thing gets above 17, that's a buy for me. I like it. I'm going to set myself an alert. Yeah, I mean, this is a great pattern here. We ripped higher. We've consolidated for about 3 weeks or so, 3, 4 weeks. If this thing breaks above 70, we could have a powerful move. Powerful move. So yeah, I like WT. I don't know if the options look like here. Yeah, the options appear to be liquid enough. The spreads are, oh yeah, spreads are tight enough. You could definitely trade these options. Yeah, great. Wisdom Tree is a good candidate. What else we got up here? ASML. ASML, I mean, that's a strong trend. I mean, you're kind of, I mean, the stock has already more than doubled since September. I don't know if I'd be buying here. It's expensive stock, so options aren't going to be cheap. You probably have to play it with some kind of spread. This one's a no buy for me. I don't like that one. It's just too far extended. And then let's see, STX. What's going on in STX? Seagate, that's a good. I mean, look, this stock has had a huge run also. Now that I think about it, off of April lows. This was a $60 stock less than a year ago. Now it's at 407. But this is a powerful pattern. This could have another leg higher. I don't know if the trade's for me, but if this thing gets back up to 450, it feels like it could be a good trade. Could be for a little quick hitter, a little quick runner. And then WDC, I know WDC has had a tremendous run. I've had a couple trades in that over the last year and have made some money. Yeah, I mean, man, these things are just so extended. That's the problem with the bull market that we're in right now. For many of these stocks, we've had tremendous runs in a lot of these stocks, and this stock was $28 less than a year ago. It's 10x. Yeah, I don't think I could buy this one here either. So those are my thoughts on those tickers. Let's see. Oh, Vinka, you mentioned Key. I'm sorry, I didn't see that. Yeah, Key's below the 50-day moving average. This wouldn't be a buy here for me. I know this sounds counterintuitive to some of you, but I like to buy stocks that are breaking out. I'd rather buy this stock at 23 than at 21. I know that sounds crazy. Why would I want to pay 23 when I could get it at 21 right now? Well, the reason, at least in my mind, is that I could buy it at 21 right now, but right now this stock looks guilty until proven innocent. This thing could roll over quickly. I mean, that might have been the top there at 23. I mean, it has the look that it could have been. I'm not saying it is, but it could have been. I need proof. I like to buy stocks that are already moving in my direction. I don't like to catch the turn. I'm not good at catching the turn. I know some traders are really great at catching either bottoms or tops. I am not that trader. Okay. I like to ride with momentum. I like to have proof. I like to have price momentum on my side. And I'll happily pay higher prices to get into something, with the exception of being, I'm not going to buy something like WDC that's already up 10x in the past year. Yes, momentum is on my side here, but at some point it becomes too much. It becomes overextended. All right. Okay. Let's see. Any more tickers in here? AEHR. Yeah, I'm looking at that one. Actually, I bought this one today. Didn't I buy this one today? Yeah, I did. I bought the Fort. Oh no, look at that. I'm trying to buy them. My order hasn't been filled. Oh, look, it's gone away from me. I tried to buy it at 570 and it's going away from me. So yeah, I've been watching that thing, been trying to get in. No luck. No luck. Yeah, thanks for reminding me. I was trying to buy it over here. I put my order in around 8 o'clock this morning. I'm in the mountain time zone, so that was 3 hours ago. And look, the stock went without me. That happens. It happens. I like this setup. I think this stock is looking really good. Again, it's breaking out of a base. Okay, so it's making fresh highs. These are the types of breakouts I love to buy. All right, and I am trying to buy it. I'm just not getting the price, and I may have to revisit that. But yeah, all right. Okay, folks, it's 30 after the hour, 34 after the hour. I think we covered all the questions in here. Thanks for tuning in. This is the What Are My Options show. We're doing this now on Tuesdays at 1 p.m. Eastern every Tuesday, or at least every Tuesday that we can, where I'm not traveling or something like that. So thanks for tuning in. Come on back next week. Meanwhile, if you're an All-Star Options subscriber, or even if you're not, on Thursday, we do the All-Star Options jam session where we review action within the portfolio, any positions we've exited, either for a win or for a loss, any adjustments we may have made. We will update stops on existing positions. We will review some of the new trades we've put on, and basically just talk about the portfolio and how we're doing. So it's a great opportunity for you to chime in. I see a couple tickers just came in real quick. Gustavo really wants me to talk about Oxy. All right, hold on real quick before I sign off. Oxy, I'm in it. I like it. I'm long. I bought it on Monday right here on this first green day. I bought it. I'm in. I like it, and today's pullback might be a gift to get in. So join me. I'm talking my book, of course. An ALB. Yeah, that's a good looking setup. I don't think I'm in this one. Nope, I'm not in this one. Good looking setup. In fact, I'm going to set a little alert for myself to buy this right here. If it gets to about 194, I think I will take a swing. Yeah. All right. You guys got it. Thanks for tuning in. I'll see you on Thursday for those of you tuning into the All-Star Options Jam session. I'll be on the morning show on Stock Market TV Thursday morning. Otherwise, I'll see you right here for this same show next week, Tuesday, same day, same time, same channel. Take care, everybody.